Thanks for inviting me to this workshop in Nairobi. I'm very happy to, if I can contribute. What I'm going to say, basically today, is the following. I've been asked by Dirk to find some data on investment. So what I'm going to say is to start with setting the stage a little, saying very briefly, sketching the domestic versus foreign investment, and I mean both private and public investment in this case. Then I will describe briefly the macro trend in domestic and foreign investment with some micro data. I had some preparation, but I'm short of time, so the things which are into brackets I'm not going to do, but I'm very happy to discuss them with you if anyone is interested, which were about the relative attractiveness of Sub-Saharan Africa for foreign direct investment. And I will do very briefly a focus on land, trying to link with the investment in water and energy. I had something on what can Europe do, but that's the subject of another chapter, so maybe we can discuss it later, and I will conclude. So what am I going to say basically about the literature? What is the literature on investment? Well, here the literature has been going on in different time. There is a literature which is of the 90s, which is why capital was not going in countries where it was rewarded more, and this is on foreign direct investment, and the focus was on security problem, on the difficulty of enforcing contracts, on the uncertain environment, on the property rights, and there is a large bulk of literature on that. This seems to be much less of a problem now in most of the sub-Saharan countries, and also in some other countries. Then there is another bunch of literature which is on the crowding in or crowding out between domestic and foreign investment. Again, there is a lot of literature. What are my main points? My main point on this, I'm not going to do the survey, which will be in a paper if I will end up writing a paper, is, so I have 2 points here. One is that the strong private investment record is actually like to act as a signal and attract also foreign direct investment. So I see the crowding in rather than a crowding out between foreign and domestic investment. And if you have adequate public structure, for instance, through public investment, these reduce the cost of doing business and therefore increase the marginal return of investment, and therefore both is very useful to have both for private and public and domestic and foreign investment. Then there is another bunch of literature which is on the effect of FDI on pro-poor growth, on inequality, and on the environment. The idea is how can you increase the developmental effect or impact of foreign direct investment. Now here my main point is that the growth effect of foreign direct investment in different sectors are very, very different. And many times foreign direct investment go in countries which are in situation of fragility or conflicts because institutions are loose and they tend to attract dirty industry. What do I mean by that? This is very important because of the externality that this kind of movement can have. Well, for instance, imagine that you have a very water-intensive industry like, for instance, textile production. Cleaning, dyeing, bleaching are all very water intensive. There are other examples of large water consumers like food manufacturing, thermal power, integrated circuits, electronic components, pulp and paper. All of these are water using industry. Now, these are not only water using, but they're also water polluting industry. So you have 2 issues that get in. You attract a foreign direct investment in paper, you get less water for the country, and you get pollution. So these are the kind of things that we have to look at. So basically, you can have foreign direct investment that can contribute to the water crisis in a country by at once decreasing the water level, exacerbating water pollution. And these are very important topics, I think, that have to be dealt with in this kind of report. So if you attract investment, basically the idea is also you have to be very careful on where you attract investment, what kind of investment you attract, both for the growth effect, the environmental, and for the water, which is one of the main issues here. Now these are my data. What are these? Now on data, I have to tell you from scratch, it's really, really difficult to find data on foreign direct investment. It's very difficult to find, even more difficult to find data on domestic investment. They are very unreliable. There is a lot of problem. I'm going to show you some data. The classification of this data is different, so I'm going to point out, to the best of my knowledge, how can you use this data. These are just UNCTAD data. What do they say? These are total foreign direct investment as a percentage of GDP in different developing areas. Basically, what you have here is that overall, you don't really have a very clear pattern, Besides the fact that in Sub-Saharan Africa they increase a little, of course 2009, the last year, is the year of the financial crisis, there is a drop. In 2010, the report of UNCTAD is going to be presented at the end of this month, the 26th of July, but there are already the preliminary data available. Apparently the things, but I could not use them, apparently things are going better. Now the issue are, developing countries as a whole had about 30% of the total foreign direct investment in the 90s, and are about 50% now. So overall, there is a big impact, a big increase in the developing countries. Now, here I restrict a little. I wanted to go into the detail. Agriculture, energy like coke, petroleum, and electricity, gas and water. This data, basically the main message of this data, the two panels are on the left, the developed countries, and on the right, the developing countries. Overall, all the countries for which there are data, these are World Bank data, and these show you that basically in these sectors, it's still 3% of total FDI. So it's very little. They're not much. So that's the only message of this. And also the categories are not the one that we are going to use, but anyway, it gives you an idea of the flows. Now these are more interesting data because these are the greenfield project, and here I was able to take out the renewable energy. What you get from here? Well, you get that basically the alternative renewable energy, which is the red bar in the graph, the number of projects, and luckily some of this data are only on the number of projects, are increasing. Even in 2009, which is the year of the big drop, as you saw in the previous graph, they're not decreasing that much. From 416, they decreased to 330. So there is interest in investment in renewable energy. So that's the main message of this kind of graph. Now this is the same graph than before, but separating the world and Sub-Saharan Africa. Now the trick here is that on Sub-Saharan Africa, you don't have the data for 2009. It was not available in Local Monitor, so you don't have the drop. But you see there is a huge increase in renewable energies in between 2006 and 2008. So this is really a hot topic. We have heard that this morning, but these are the only available data on this kind of issue. So now let me focus on Sub-Saharan Africa. So far, I said, FDI are not that many, but they are increasing. And one thing which I didn't say, which is important, is they've been slightly more resilient than other private finance investment flows than in the crisis of 2008, 2009. Now, what's the common wisdom as far as foreign direct investment in Sub-Saharan Africa are? That is low with respect to other developing areas, that is concentrated in few countries. The African Economic Outlook that came out last month say 15 countries get most of it, is concentrated in natural resources. 70% is still in natural resources. However, recently, foreign direct investment has been growing, while domestic, both private and public, have been stable or decreasing. So apparently, the foreign direct investment have been reacting much more to the macro situation than the domestic investment. These are some trends on the foreign direct investment over GDP, private investment over GDP, and public investment over GDP over a long period of time, 1970, 2005. And I have the new data, which I will show you in a moment. In Sub-Saharan Africa, only for 38 of these Sub-Saharan countries, these data are all available. What you have is that you have an increase, as you can see, of the foreign direct investment, and a sort of decrease between the 1970s and the 1980s of the other two, and then a sort of a stable pattern between these two. And this is the same, but at the country level. This is the last available year for which countries, for many countries have more, but then otherwise you couldn't see anything if I'd put more. What can you say here? This is the gross private investment over GDP, gross public investment, and foreign direct investment. Now let's look at something. If you compare any of the countries with the Sub-Saharan developing countries only, you have that some of them are above the average and some of them are below the average. Now what do you expect? Do you expect that you have a similar pattern? Are the factors the same that attract domestic and foreign investment, that increase domestic and foreign investment? Look at Kenya, for instance, since we are in Kenya. In the private investment, we are much below the average. It's 20%, the ratio of private investment over GDP. In the public investment, you are more or less on average, slightly less, you may need more. I've seen road being built, so maybe there is more public investment now. Foreign direct investment, very, very little. So Kenya seems to be like a crowding out of investment. In other countries, you don't have that. In other countries, they go hand in hand. And one could elaborate, I mean, of course, on one point in data you can't, but I have the data by year, so you can actually say something more about the data over here. Because being net inflows, of course, it just give you an idea for 1 year, but it cannot give you a picture. Now, so what we said is FDI have increased, but they're still low. However, they are increasing with respect to some emerging countries. Maybe you cannot see much, but this was just to give you an idea. This up here is China. China is getting a lot of foreign direct investment. This is India. India again is getting more, but this is Africa. Of course, Africa as a whole is below India and China, which are two countries, but they are large countries. But you have Russia and Brazil below. So even when you compare with emerging countries, Africa is actually becoming more attractive. If you see here, we are very lower, and then it goes sort of up. However, the share in global new foreign direct investment project in Africa is about 4%. So in this slide, what you have are two issues. One is the number of projects and the share over the global foreign direct investment. So for instance, the gray bar is the number of projects, while the yellow point is the share. You see the share is around 4.95% of direct investment, of the new foreign direct investment project. Where in Africa? Very little in Eastern Africa, as you can see. Look at the Eastern Africa is literally very, very low, the level. Northern Africa, Middle Africa, they go more. So what you get is a very heterogeneous picture of foreign direct investment. These are the number of projects across Africa, some countries in Africa. The source of this is the FDI intelligence in 2011, and you see you have South Africa, Egypt, Morocco getting more, and then you have Ghana, Libya, Kenya getting less. And I mean, this doesn't account for the recent event in North Africa and the war in Libya as well. It's very difficult to understand, but basically what it is. These are the data which I found, which are the foreign direct investment in Sub-Saharan Africa in dirty industry. So overall, you have very few investment. And where do they go? They go into dirty industry. So here, this is by year, the project. You see, for instance, a paper packaging. Now, you cannot really see the year, but I can. I don't know, in 2003, you have 3 new investment in paper packaging. Then you have another 3 in 2006, and so on and so forth. So careful, because they attract foreign direct investment, but they go into industry which are water polluting and water users. So this has an impact. This is just a summary of the number of projects with private partnership. Here I'm getting slowly, closely to the topic of the section, which is on the private-public partnership. What are these? The data are from the World Bank, the public-private partnership data, and the sectors, again, are divided into different, the classification of the sector is different again. But if you see, is that basically in Sub-Saharan Africa, the projects are still much lower than in others. Look at East Asia and Pacific here in water and Sub-Saharan Africa. Now, where are in Sub-Saharan Africa? These are the disaggregation that I could find, basically in telecom. And if you look into this, and you look at the number of projects with private participation in Sub-Saharan Africa by sector and year, in these 3, energy, water and sewerage, and telecom and transport, you see that telecom and transport is up here, and water is really low. So there is very little foreign direct investment, there is very little domestic investment, and there is very little private partnership, public partnership into the water sector, which is so crucial, because if you have it in polluting industry, of course, then you should have something more in the water sector. This is exactly the same, but numbers of projects, in case you could not see the previous one. So what am I going to do now, because my time is running out, is to do very briefly something on land. We will hear tomorrow evening at this point, I suppose, something more about land, so I better say something, but I will say very little. I prepared my abstract on land, then Dirk asked me to change it, so I did it, all of these slides, spending the last week, all the nights and everything doing the data. This is part of a presentation much longer that I did on land, and basically what it is just gives you an idea of how many are the transactions in land. Now you see, if you have in the top, in Sub-Saharan Africa in blue and the rest of the world in red, basically you get that for Sub-Saharan Africa, the investment in land are very, very important. It's a diffuse. There are investment in land also in other countries, but in Sub-Saharan Africa, this is a very relevant issue. Now, you can have purchase, but you can have lease. And that's another issue which I think is very important and most likely will be discussed tomorrow. What are the motives that drive investment in land? We have heard this morning, increasing and shifting demand for food, feeds, biofuel. That's the link with the energy. That's a very crucial, and that's important also when you go and speak about the EU policy, because that's one of the crucial issues, I think, on the policy. Of course, the fuel prices are above the historical level. They are increasing. They are high. People want to invest in alternative energy. Not that, only because you also have that the value of agricultural land is increasing because it's relatively scarce. We have heard that this morning as well. And Sub-Saharan Africa is vast unexploited agricultural land. Just to give you an idea of the prices for agricultural land has increased about 16% in Brazil in the last 10 years, 31% in Poland, 15% in the US, nothing in Africa. In Africa has been stable, has not increased much. This is something that attracts investors, of course. It's cheap, it's available. So there are investment in land. And then the third reason is government in countries that don't have enough land and water to feed their population are making investment in order to secure food supply. Careful, not only they're making investment, but these investments are the water intensive, because it's obvious that for South Arabia or for China, it's better to use the water in Africa than to use the water they have at home. So if they have something which is more water intensive, they rather do it in a land that they lease and is not in their own country. So that's a drawback of this kind of investment. Now, for what, how, where, this is going to be discussed tomorrow. I'm not going to go into detail. What is important, however, is what I put up in red. One, the duration is medium term, usually of this kind of investment, but especially the source is domestic private investment, foreign private investors, both individuals or large companies, and also foreign sovereign funds. So you have all sorts of the agents that we discussed which are investing in land in Africa. Of course, the type of tenure arrangement are the lease, the concession, the illegal enclosure, or the purchase. The purchase is the rarest of all of these. So they're less purchased than the others. Now, just to go back to the topic, that's some large land transfer in Africa on the left panel. Basically, if you want to have an idea of the distribution of foreign and domestic investment in land, what you get is that the foreign investment dominate. The foreign investment is the blue, the national investment is the red or pink or whatever. Basically, both in terms of hectares and in terms of dollars, they dominate. The foreign investment, this is just in Sub-Saharan Africa, they dominate. So what about public and private investment, to go to this topic? Well, this is interesting because here you have a very different result if you look in terms of size of the land which is bought, or if you look at in dollar terms. And that, I think, is an interesting contrast. What you have in hectares is that the private sector alone dominates, really dominates, as almost everything is 5% what is left over. Well, if you look in terms of value, the actual government owned whole or partly, therefore in some partnership, is very, very large. And that's something, that's Africa. These are only in Sub-Saharan Africa, yes. Now, what is the issue? This is a very incomplete picture of land deals in some African countries. I had many more. What I wanted to give you an idea, I didn't put the hectares, I had the data on the hectares and so on and so forth, the type of contract, but basically this is going to be discussed tomorrow. What I wanted to give you an idea of is the following. This is not only for food production, but it's also biofuel, it's tourism, it's mining. So when we speak about land, be careful because we speak about an enormous amount of things. Look, for instance, tourism. This is a resort. People buy land to have resorts. Now go back to what I said before. The pro-poor effect of investment in different sectors is very different. So this is very relevant if you want to know what is the effect of this investment, to find out exactly what can be the pro-poor effect of investment in some of these. And then you can go more into detail of that as well. So the only major food crops here is the rice. And this is for the Asian market. I mean, then of course here you have other issues like where they go and so on. So now, and I will try to wrap up, the potential opportunities of investment, this is in land, and then I will wrap up. On one hand, people can say, oh, there are a lot of opportunities. They can create employment. Careful about the sector. There is a lot of land which is unexploited. This could improve because you can have more food. Here, you have to look at the data for Africa. For instance, you have the lowest milk and meat production per animal, the highest cropland area per tractor, the lowest use of fertilizer, the lowest share of irrigated area. Again, this is a link between water and land. The issue, how much is rain-fed and how much is irrigated. That's another issue which I think is going to be discussed tomorrow in the session. Now, if FDI can bring access to technology, they can enhance opportunities, market opportunities. There is an issue that here is also, there are sex differences. There is a gender issue here between men and women in terms of market opportunities. One thing which is important is that if you have a better enforcement and infrastructure, this can help both the domestic and foreign direct investment. And these, for instance, could be in complementary industrial services. And again, you should look at how the industry complement themselves. Do you need a distribution service if you have a food manufacturing industry, and so on and so forth. And finally, the other thing which I think is very crucial, to which you want to condition the potential opportunities, is the level of human capital, because you want to see whether the countries which is receiving the money has the proper absorbing capacity in terms of human capital. And that's, again, something which needs to be looked at. What are the concerns? Many, a lot. There is a large literature, raising literature on concern. There's plenty of conferences on concern, on the land grabbing. Even the name land grabbing tells you something about the concern. Investment may be detrimental to the effort of Africa towards poverty alleviation and food security. Being market-oriented does not contribute to the national food security objective. That's obvious. This is especially true for biofuel project, or when the food is only for export. Of course, if you have a division of food between domestic market and export, this is different. The technology that people could get, which were in the opportunity there, if they had the right human capital, if they were able to absorb them, they may not be the scale and the type that domestic production system can use. Usually the domestic are small farmers, so that creates a problem. The agreements are often non-transparent. They do not involve parliament, civil society. Land acquisition sometimes cause eviction of local farmers without adequate compensation. Compensation is, again, something which is in the picture and is important. Possible negative environmental impact. Different interests of different groups within a society. The poor farmers, the government. Here you can get into all the issue of corruption, ethnical groups, land rights, and so on and so forth, which I'm not going to discuss, but is obviously behind all of that. So let's try to link the foreign direct investment in land with water and energy. 1 minute, okay? The UN was quoted this morning at the beginning. The future constraint of food production is water, not land. More land concentration through large-scale farming is likely to lead to less water access for the poor and the owner-operated farmers. That, I think, is a very crucial issue. Irrigation farming accounts for only 19% of cropland cultivation. Local small farming food production has lower transport costs. So again, this is a link with energy. If you have large farm land acquisition, but then the food has to be exported very far, of course you are very far from the 0 kilometer ideal type of market, you have a lot of expenditures in energy. You can have measures to improve small farming productivity, greater efficiency in the use of irrigated water. So that's an issue which is important. For instance, there are a lot of examples on the pedal-operated water pumps in semi-arid India. There are issues of this kind that can increase the productivity of farmlands. As a matter of fact, there is a very recent report which the World Bank has come out, and I think was mentioned probably this morning as well when you mentioned this on the land grabbing and water, and they insist a lot on this higher productivity of small farms in a lot of sub-Saharan Africa with respect to the large farmers, which is linked to issues like irrigation, rain-fed, and so on and so forth. And then you can have other things. So let me try to conclude. What I want to say is the following. A, water and farmland are very, very important resources for most, but they're also assets for most of the sub-Saharan African countries. So they are resources and assets at the same time. So that's a very, very important. I believe that there should be crowding in and not crowding out between domestic and foreign investment. And a lot of more research should be done on how the domestic investment impact the foreign investment and vice versa. So if you want, from a technical point of view, with estimation of a sort of a simultaneous equation for foreign direct investment and domestic investment, but the sectoral data are very, very difficult to find. Why do I think so? Because the improved investment climate, which exists in sub-Saharan Africa, it has improved. If you look, Ernst & Young has come out very recently with a survey which they submitted to investors, and Africa now looks even more attractive than Southeast Asia in a lot of sectors to investors, and this is done in the north from Ernst & Young. So that's very important. So if you have good things, why should they not attract also the domestic investment? So here is a question of contract enforcement that can get banned again. Importance of sectors. Dirty industry because of the pollution and the use of water. Externality between sectors. If you invest in one, you may have to invest in another one. Complementarities and so on and so forth. Different growth effect. And therefore, if you want to stimulate the consumption, that's again something which was discussed this morning, you need to invest in industry which have an impact on employment. Water, land, and energy cannot be studied separately, and that's what we are doing. But there is a need for better sectoral data. There are no data. We really need data. The role for the EU is very important. You mentioned before the policy coherence. A simple example, correct incentive for biofuel. That's something that should be done. Best practice can be learned from Europe. Some code of conduct can be suggested by the European Union or donors countries and so on and so forth. As for the land, there is a need for public debate in those countries. There is the need to consider a wide range of options and learn from better practice. There are some cases which are good practice. And it's very important to remember the water and energy links when you speak about land. Thanks.